Good afternoon, ladies and gentlemen. Welcome to our webinar on how to create your financial fitness plan. Just before we get started, a few quick housekeeping rules. Disclaimers first and foremost. Dunhill Financial is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer, solicitation for the sale or purchase of any specific securities, investments, or strategies discussed herein. Investments may involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategies discussed herein. Quick introduction about Finimize. They're an application which gives you a roundup of what's going on in the markets. Now I'd like to jump straight into what's been going on in the global markets, so to speak. And one of the trends we've been seeing is in currencies, mainly the US dollar. So what are your thoughts on the US dollar, Brian, and why has it turned from a smile into a frown lately?
Good afternoon, Kim. Thanks for having me here. And yeah, this is an interesting question. We've had a quandary over this because we've spent nearly a decade in one directional market when it comes to the US dollar from the recovery of the financial crisis. That was progressed with the pandemic as everybody jumped into the flight to safety, i.e. the currencies they deem safe. And these have decreased because of commodity prices going down, i.e. the Australian dollar and Canadian dollar falling off the list. Brexit making the British pound no longer one of those safe currencies. So we're down to just Norway, Switzerland, Sweden, and the United States being the prominent one. So the US dollar increased significantly over the long term, and then even more so with this pandemic. And now in the last month, as you just stated, we've seen it take a breather, a nice big breather, a 5% decline in 1 month. And this is impacting all the markets because when we really break down the S&P 500, 43% of their earnings come from abroad. So for every point that the dollar goes down, we would expect nearly half a point increase in the S&P 500 directly correlated to that. So this is going to impact global markets. It's going to impact stock prices. And we're of the mindset that when we start comparing PPI, the easiest way is through that tongue-in-cheek Big Mac index that the Economist has been publishing since the 70s. We can look at it and say that the dollar should come down much more as things normalize. When they'll normalize, that's the question. We need a vaccine for that. We need economies to recover, but the dollar could slide much more significantly, and most importantly, to do with our favorite country that we've been discussing for a while now in China.
So if we jump into what's happening over in China, specifically with the Chinese yuan, it's had a roller coaster ride. So, what's been going on over on that side of the globe?
Well, we've had a 2-month period in which we've had a 4% increase in the renminbi. This seems contrary to what we've gone through in our entire life, to where the Chinese have been trying to devalue their currency for most of our lifetimes to make manufacturing as cheap as possible. But just like they made a run to become one of the global reserve currencies back in 2008, we believe that they're making another run for it. And in the last 2 months, it looks like that strong run. This is extremely important on several factors. The first one is the fact that they're sitting on $1 trillion of the US deficit. So if they become a stronger currency, if they no longer see the need to hedge their currency in that way, all of a sudden we could see a mass sale of US treasuries, or at least not see a mass renewal of those from the Chinese. And there's not that much demand amongst Americans to buy US debt like they have in Japan, where they don't mind buying their own debt. So if you can't find the buyers, interest rates either have to go up, or even worse, they might have to actually potentially default on their debt. The US having 32% of the world's debt, when we think of government debt, corporate debt, and personal debt, means that a devaluation of the US dollar in a significant way could turn into a collapsing of the house of cards. This is the thing that starts to to scare us in certain ways, and that concentrates our minds that these currency movements are much more important than anything else that's going on in the global market. And those are the big influencers to some of these sector trends that we've seen in the marketplace.
Mm-hmm. So I guess we've sort of established that currencies play a large impact on the markets overall, sort of a larger impact than a lot of people would like to prescribe to that. But then in recent sort of months, we've witnessed a number of sectors, across the global markets where, they've gyrated, up and down a lot. So what's going on a sector specific basis?
Well, they say that these things are unprecedented, but we've got nine epidemics and pandemics in 20 years. That means we have plenty to pull from. And we've always seen the top three sectors in any of these types of financial crises go into healthcare, consumer staples, and technology stocks. So this time's no different. Naturally, people gravitate towards what's in the news. But based on past precedents, especially when it comes to SARS back in 2003, healthcare and consumer staple stocks fall back into place. Actually, they might take a bigger dip once things normalize. The tech sector continues to grow. And that's why we've been focused on this tech sector, and we'll continue to stay focused on the tech sector, because in past precedents, it shows that they should stay resilient and continue to grow their sales, grow their revenue, and continue to build. We've decided to focus on one key factor, which is the strength of the balance sheet. We don't know the main variable in when is this virus going to go away and when can we get back to normal. Nobody really knows that. So mine is just gambling at when that could take effect. We're looking at good, solid balance sheets that we can guarantee the company will be there once the vaccine is here, or that the virus is over. In other words, if we own companies like Brooks Brothers, Neiman Marcus, and the likes that are going bankrupt, they can never come out of bankruptcy for the shareholders to make money. The companies can come back, but us as shareholders, we'd lose everything. So we're concentrating on strong balance sheets, strong companies in strong sectors based on those past precedents.
No, those are very valid points you bring up. So what sort of stocks are you looking at this summer? What's caught your eye?
Well, we've been playing in some of the obvious places, in the e-commerce and any of the payment platforms. Naturally, these are obvious places to go because an Amazon, for instance, is it's easy to decipher that if you like the price last year, yes, the stock price has doubled year over year, but so have their revenues. But we've also been looking at hedges. We spent 2 out of our 3 big questions today for the month talking about currencies and how do we make sure that we don't overthink currencies, but we hedge some of that currency risk. Well, the obvious places are gold and silver. Those have been a little bit overplayed, but they still have room to run if these currency markets are going to move as much as they would. I'd love to be wrong about that. I'd love for our gold and silver positions to be losses next year, because that would mean that the market's stabilizing in a big way. I fear that we're right. But we're also looking at more creative hedges. One of those creative hedges is in eggs. Now, eggs sounds like a funny place to be looking at in the middle of a global crisis. But simply put, an average grocery store has 110,000 items. With 110,000 items in a grocery store, we can start looking at all the different places. And if we were predicting that we were going to have heavy inflation, we would actually buy blueberries. Blueberries are the fastest item that grow with inflation or above inflation during any kind of crisis. The item in the grocery store that doesn't grow by inflation would be potato chips. So think of your Frito-Lays and the likes. If we didn't think we were going to have an inflation, i.e. the last 20 years in a grocery store, that's the item you really want to buy. Now, we're not sitting there taking a stance that inflation is going to go through the roof or going to fall through the floor. We're nervous about inflation being affected by these big currency moves and by all of this quantitative easing and monetary and fiscal policy changes. Of the 110,000 items in the grocery store, essentially the only item that goes lockstep in line with inflation are eggs. Now, eggs are a much needed commodity for any baker, any restaurant, and any household. It's typically in every single grocery basket. And so this is a common commodity that grows in line with inflation. And what we've seen is pre-pandemic, we were sitting at 97 cents per dozen eggs. Now we're sitting at $3 for a dozen of eggs in the United States. We've even seen lawsuits from Texas basically saying that Cal-Maine, being the biggest egg producer in the United States, is price gouging. That being said, prices have changed on certain functions. Are they price gouging, or are we just seeing a precursor of inflation? We're not picking a bet. We're looking at how can we hedge our portfolio just in case we see too much inflation. And Cal-Maine has presented itself as a wonderful opportunity, even more so because one of the founders' family members has sold off a big chunk, actually kicking into a lower price. So we're seeing a nice opportunity for that to hedge our portfolios just in case we have inflation. Like I said, we'd love to see that position in gold and silver at a loss, because that means we didn't need the hedges and that we can just go with regular market moves. The Visa and the PayPals are those obvious plays as you walk into more and more stores and they basically tell you, we're not taking any cash. It's dirty. It might have a virus on there. Go ahead and tap your card. That's it. You know, all of a sudden we have a marketplace where the government has a monopoly on cash and they're handing it over to these key players, the Visas, the MasterCards, the PayPals, you know, all the way down to the other players over in China like WeChat and Alipay, who are essentially potentially going to go IPO this week. So that's an obvious play because the government's handing them that new business. In the e-commerce side, we've shifted from really liking Amazon because it's been easy to decipher. It's been easy to look at huge growth, nearly 45% growth in their AWS services. And even more so during this summer as we've had some Senate inquiries, the potential of dividing up the FANGs gives us the opportunity to look at past precedents of AT&T and Standard Oil bringing about a ton of value by dividing up those companies and looking at the waterfall valuations of those companies. They would be worth much more divided up rather than together as those FANGs. So we would love to see them divided up. It would give us the opportunity to pick and choose which businesses we would like to be in. That being said, we love AWS. We don't know if we really like the retail e-commerce side of things without AWS servicing it. So we've started to shift some of those profits that we've made from Amazon into Shopify. Our Canadian friends that are competing against Amazon in many ways have differentiated in one key fashion, which is that they've started a banking unit over there. Building a banking unit during a financial crisis is a funny time to do so, but I see it as a true value play because they have more information than any bank would on all of these companies. Yet, at the same time, they don't have any of that bad debt pre-corona that no bank would have known was coming. So they have a perfect balance sheet for their bank. They have the perfect opportunity to grow the right companies, and they have all the data to meet that, which in this type of marketplace is a godsend. So those are some of the plays that we've been playing this month. And I'd love to see what you guys think about them.
My name is Jasper MacDermot. And since I was 16, I had actually wanted to be an actor. My mother had, in her 20s, lived in Venice Beach in LA. That was always me. That was always the thing in the future, is when I get to LA, life's going to be gravy. Got a 3-month visa to go and study at an acting school there, without so much as any sort of plan and not a lot of gumption. Getting to LA was certainly a bit of a hit in the face. You know, you build up the notions of what it was going to be like, that I was going to get there and someone was going to come up to me and, you know, and say, hey, you're the man. You want to be a movie star? I've spent the last few years wanting to be here, wanting to be everywhere but where I was, thinking that I'd be a different person. I'd be the person I've always wanted to be. When I got to LA, lo and behold, I fly back to England, and the very next day, I'm due in work, pushing a trolley around a supermarket, doing other people's groceries for them. I had always been into physical training in the gym. It was my only outlet. It was the only place that seemed fair to me. You know, you go in, you put in the hard work, you learn more, quickly sort of turn things around. You know, I got into it because I realized along the way I'm good at this, and it beats doing everything else, if I'm completely honest. I hadn't quite realized the implications of what would come, or what it was actually about. I found myself having all these extraordinary experiences and conversations with people. I was finding it to be like this funny gateway into the most personal and intimate of relationships that you can have with people. This is a really extraordinary opportunity. Am I the only one that's seeing this as the kind of the most extraordinary privilege? It was my first real thing where I was seeing all these people that were willing to be vulnerable because they were fed up of something. You have someone that wakes up and they look at their body and they feel shit about it. And the first port of call is, yeah, change my body. So I go to a trainer. And then all this other stuff comes out that people have been repressing. You're doing squats, you're doing lunges, you're pushing, you're pulling, you're moving your body more. It seems it's really basic, carnal shit. But for whatever reason, it bleeds out this other stuff in doing so. Yeah, this is the most alive and the most valuable I've felt as a person. Does this happen in other people's jobs? This is such a privilege. I'd spent pretty much since I was, you know, at school, how am I going to be the man? How am I going to be happy? But it wasn't until I flipped the switch, I suppose, and thought about, okay, how can I use whatever I have to help someone else? I've never felt more valuable, more important, and more appreciated. And it was the first time I really had felt that feeling. People end up miserable, it seems, because they're held back by their fears and their inhibitions and their resistances. And if we put it down to something so basic as, I want to get in shape, no one ever does because they're so afraid of it. You have to go there, you have to show up, you have to put in the work, you have to sweat a little. Everyone's always telling you to be more confident, which I've always said is, this is horseshit advice. Telling someone to do anything isn't really going to cultivate much. Be courageous, not confident. Courage is knowing you're afraid and acting in spite of it anyway. If I'm afraid to write something, to put something out there, to say something, I know that it's probably because it's powerful and it's going to leave me maybe vulnerable, but that the rewards of such will yield the best things. It stops being about body fat levels and protein and reps, and starts being about what am I capable of in this world. Stop being afraid of all these things that you know you want to do. Take that fear, acknowledge it, but go forth anyway.
I think with a promotional video like that, who needs introductions, right? So let's jump right into it. Learning about finances can be daunting, especially when you're starting to read into it, seeing all these formulas, these numbers and theories. But when it comes down to it, it really just has a lot of parallels with many things we do in our everyday lives. So knowing that finance is essentially a reflection of life, we're on a quest to find these parallels and analogies that can actually help us get a better understanding. To start off, we have our guest, Jasper McDermott, who I'm sure you've witnessed in that spectacular promotional video, a personal trainer and a nutrition coach working at Outgate CrossFit, helping clients to achieve their fitness goals with a focus on planned workouts and balanced nutrition. So where do we start in putting together a fitness plan?
Thank you for having me on here. It's all about meeting the person where they're at. Fitness can be a wildly confusing and intimidating endeavor. And it's my role largely as a coach to meet someone where they're at, no matter what their current state physically, and certainly their current level of fitness, and understand how we're best going to get them to what it is at their end goal. And that's going to be different for absolutely everybody. So it's just about having a really nice conversation, building trust with someone, understanding what they want to get out of their fitness, which will be unique to the person, and then reverse engineering that outcome to what the plan looks like up to our first session together.
See you, Jasper. I couldn't agree more. A financial plan is very, very similar. When we're assessing the cash flow, the balance sheet, i.e. same thing as the fitness levels, we really have to start with Simon Sinek's line of start with why. If we're only investing to get rich, odds are that we're going to get frustrated or bored at some point and lose our motivation. If you build a long-term plan to save for retirement or a house purchase, and you break down these steps into manageable small increments, you therefore get to the point where you're running that marathon. Many people say, we'll start saving once things normalize, once the markets get to normal times. But name me a decade in which a major nation hasn't been at war, and some time in which there hasn't been a big credit crunch someplace around the world. Yet we think of it, the markets continue to prosper, and they will continue to prosper. Sometimes the stock market looks like a bunch of dirty shirts, and we just have to find the cleanest one. But that still allows us to go out and get the job done. The best day to plant a tree was 20 years ago. The second best day is today. So we just have to get started and build that incremental plan.
So in a sense, your core is like a tree trunk or a twig that's sort of being swept away in a hurricane. It's not exactly rocket science, so you should really try to keep it as simple as possible.
Yes, I think the mistake is overcomplicating these things. And as I said, the industry itself can really misdirect and confuse people, almost in an attempt to show that they've got the golden ticket, when really it's just about doing the basics, certainly in a capacity that you enjoy, in a way that's going to be sustainable. As we all know, sustainable, repeated efforts in whatever the endeavor is what leads to lasting change and real results, instead of something that's very fleeting. So yes, 100%.
This analogy, because in managing portfolios, we use this core plus satellite approach, the old Goldman Sachs model, which in a nutshell means we have our core positions and sectors we focus on, but around that we consider the hottest trends in the market, as we discussed earlier in the last session. This couldn't be better fit for the fitness analogy. We never allow our satellites to take over more than 20% of our portfolio, just in case we're wrong. Having a strong long-term plan and sticking to it is the most important thing we can do. Passive investing is often the best option for new investors due to the low cost, yet offering full diversification that you can achieve through these instruments adds to the zeal of the portfolio later, once you have some experience under your belt and you know how to handle that volatility.
Going back to another example of the baker's dozen or the odd lots theory some people like to mention, more reps doesn't necessarily lead to better returns, do they?
I mean, as with this, context and nuance are everything, and that's something that's lost in today's world. We just like big, statements, as it were. And so I can't give you a simple answer. I just wouldn't feel good about doing that. But yes, if you saying something as simple as more reps will lead to results is definitely a short sight, because oftentimes people think they need to be doing more, if that's what you mean, whether it's harder workouts, longer workouts, or indeed just more repetitions in one set of an exercise, is not the case. It's certainly about working hard, yes, but smarter, more importantly. And as I said, it has to pertain to what it is that we want the end result to be. All right, so there's no arbitrary prescription one can give to any given individual, if that's fair.
Just as Jasper said, thinking smarter is the key, and prioritizing the most important things. If you have no set goals, all of a sudden you can end up concentrating on a million different factors, a million different goals. We have plenty of clients that come in saying, I want to do this for my kids, this for my estate plan, these 10 goals, and I want to start a business. And all of a sudden they're slicing their dollars in 5 ways, which it can't amount to. That leads you to paralysis analysis, or as the grammar police would say, analysis paralysis. And so therefore you want to have smart, achievable goals for the short term and the long term to meet those objectives, keeping them smart. Again, ask why. Why are we putting together this plan so that we can get through those bad days just as well as the good days?
So I think we've established that it's a marathon, not a sprint. it's not about what I can do now, but more about where I want to get to. What are my goals?
That's a really fair assessment, and that's one of the hardest sells, I would say, in someone that wants to come in, because it's, you know, it's usually often say a physical related goal in terms of an aesthetic outcome, whether that's the common goals of the things like weight loss or building some muscle, and we often the initial mentality is that we want that quick. That's just in human nature, right? Whether it is in finances, we want to make money fast. We hate the idea of having to stick at something for a long period of time. So that largely becomes the backbone of the educational process, the communicative process that I have with clients, is just showing them that, yes, you can achieve plenty in a short space of time, depending on your level of adherence and commitment to certain variables. But it's in your interest to look at it as a long-term thing, because fitness is something that I encourage people to have part of their lives, whether you're 22 or 82. Yes, they might look different, but it's something that we always want to have there. So when you have that mindset, you stop having that, oh, I've got to do everything now, I've got to change everything overnight. And suddenly the world opens up to you, and there's no limit to what you can achieve with that mindset. Patience is a lost art form for sure.
The thought of that, Jasper, that you need to have fitness from 22 to 82, and financial planning is that same way. The 82-year-old needs to have that good cash flow. The 22-year-old needs to be thinking about what they're going to do to get to being 82. And it's not about time in the market, timing the market. It's all about time in the market. So most of those returns are achieved by being in the market for a long period of time instead of quickly dipping in and out of those marketplaces. The same thing can be said about dieting and your fitness plan. So just reiterating everything that Jasper said, we have to be patient to get to our goals. We have to put down our goals. And, you know, character is defined by how we actually learn and respond from those bad days in the gym, those bad days in the market. If we sell out every single time that we have a global pandemic or a financial crisis, we're not going to achieve those long-term goals.
I think that sums it up really nicely. You know, everything should have a plan. And in essence, if you don't have a plan, then you're setting yourself up for failure. You know, planning is everything these days.
It's been codified in myths, proverbs, analogies, which is just the case of, if you don't plan, then how can you expect to have any outcome any predictable outcome, right, or any desirable outcome? And that's not to anyone's fault. You know, fitness, whilst it does seem like an everyday thing that everybody should be doing, it has so much to it, and no one can be expected to know how to do all that themselves, which is certainly why I have a job, but certainly why anyone in the finance sector has a job as well, right? Because these are all things that we go to people to help us journeyman, help us journey through that process, I suppose. So whilst that is correct, you do need to have a plan, and there's plenty of resources out there. It can be very hard to filter it through into something that's proactive and effective, not too much, the right amount for where you are. And that's where a coach comes into play, for example.
But he should have a financial plan, just like a fitness plan, as Jasper is saying. But the thing is, whether you need a coach or not, everybody doesn't necessarily need a coach, but everybody definitely needs a plan. And a lot of financial professionals actually choose to have a financial advisor still, because this helps keep them in line. It keeps them getting to bigger goals and improving what they're doing. None of us are omniscient. All of us have our flaws, and therefore getting coached through those types of flaws, being able to see from the outside in is extremely helpful to myself. This is why I have a personal trainer in Jasper for my fitness goals, and why I still have a financial advisor to keep me in check, even though that's what I offer to others. It's been wonderful talking to you, Cam. Wonderful seeing you, Jasper. Thank you so much for the opportunity to talk about the relations between fitness and finance, and I look forward to all the questions that are going to be following up with this.
Perfect. I think we'll open it up to our Q&A section now. We've got a number of questions here, but before we do that, let's just launch a quick poll just to gauge the mood of everyone here in the audience. So obviously with the markets having recovered quite some bit, the question is, what are your thoughts on the market so far? So we'll set that poll out and see what sort of responses we get for that. But in the meantime, let's start addressing the questions that we have. Let's get one of those up. Once again, feel free to type out your questions in the chat box, ladies and gents.
Looks like we've got a quiet bunch, Cam.
Well, I guess whilst we wait for some of the questions to roll in, it looks like the poll so far is pretty evenly split when it comes to the recovery in the market so far. It looks like a lot of people are sort of trusting the recovery so far, and a few others are sort of, a bit skeptical of what's going on. We've got a question. Yeah.
Sorry, go ahead, Cam.
Yeah, it looks like we've got a question from Andy. So he's got a question of, are US stocks overvalued and should he be looking elsewhere?
Well, in my mind, it depends what sector we're looking at. When we're looking at certain stocks like Amazon has doubled in the last year. So it's very easy to jump to the assumption that it's overvalued, but their revenues have also doubled year over year. So when we're looking at historic multiples, it looks like it's in line. We're also looking at opportunities that if these companies are forced to break up from regulatory basis, that the valuation should be actually much higher. And the third piece, which was what we were going over in the beginning, is that the devaluation of the US dollar actually leads towards more profitable companies. We've seen this, we forget about this as analysts, but 43% of the S&P 500's earnings come from abroad. So every time the dollar goes down, those valuations should go up. So the way we're looking at things is that we're only looking at certain segments of the US market. We're getting out completely of over-indebted companies and companies that have poor balance sheets. But being selective, we find that there's still some opportunities over there, and definitely a lot of opportunities abroad with the devaluating dollar.
Yeah, no, definitely. We've got another one from Samantha Allen. So the question is, an area that she's been hearing a lot of interest in is a rise in environmental investing, so green energy and ESG oriented ETFs. What's your take on that?
I think it's been a great long-term changeover in that. 20 years ago, I remember people talking about it and saying that it was going to be detrimental to your returns. Now, when we just make a simple comparison of the KLD 400 versus the S&P 500 on 1, 3, 5, 10-year basis, you'll outperform to be socially responsible versus socially irresponsible, if there's such thing as calling it socially irresponsible. Now, simply put, we know that's because energy prices have gone down. And when energy prices go down, the irresponsible companies are going to do worse than the socially responsible companies. But that being said, we're seeing a lot of government action in those territories. We're seeing a lot of investment shifting in those areas. And we've actually made the push into those areas just to be ex-oil and to be in the right place on those motifs. So I do believe that it's the right place to be.
I guess we've got another one from Sarah Velko. I guess this kind of answers the question with the poll that we've currently got going of whether people have found themselves being slightly more active versus passive due to this pandemic. And then I guess let me just share the results so we get a good idea of what the thoughts are of everyone. It looks like it's a fairly even split, with 45% being somewhat active in their investing and about another 43% slightly active, but again, leaning on the passive side, and about 12% fully staying to that passive mantra. So again, the question is, with talks of various ETFs this year and a lot of passive investment flows into that, what are your sort of thoughts on that?
We always follow flows, Cam, especially for our team. And one of the flows that I found unbelievable this last month was the top 20 ETFs in the United States. One of those top 20s to invest in was actually real estate. When that's the last place that I'd be trying to allocate money, because it feels like we're just trying to call a bottom. So while we're not touching real estate, we're noticing a huge shift towards active investing. In a community like Finimize, I would expect that to continue because, well, to proliferate, because essentially there's going to be more active investors than passive investors in a community like this. But I think everybody should be thinking about that from an ESG perspective, from ditching the losers. I think if anybody concentrates on balance sheets right now, they can outperform the market easily. If you ignore that and only look at flows or only look at investing passively, well, you might end up underperforming that little bit. So we're taking that view. We're going towards as many satellites as we can and trying to get our outperformance based on currencies and based on good solid balance sheets.
Yeah, no, definitely. I think there's a lot of schools of thoughts out there, when it comes to investing, whether that's, the flows concept or fundamentals, balance sheets, etc. But, I guess it's a matter of taking a mix of all of them and, finding what works for you. We've got another question from Dalvinder. So I guess this is a more general question. Why does an economy rise and why does it decline? What are sort of the factors that come to mind?
Well, essentially, we gave 4 reasons in our last newsletter to our clients. And the first one, when we set these precedents of what's happened in past pandemics and epidemics versus this one, is that the rich typically get richer in pandemics and the poor get poorer. That's not what we want. That just is historically what happens. And I think the easy example with that is the fact that I think it was Fortune magazine, but please fact check me on that. They ran a statement that 2 in every 3 restaurants in America was going to go out of business in the next year. Now, whether that number's right or whether it's going to be 50% or 75%, I don't think that matters. I think we can all agree that restaurants are getting the brunt of this crisis. Yet, when we look at the public companies, the Pizza Huts, the Papa John's, the Domino's, they're built for a pandemic. They're all delivery and they're all takeout. So they didn't have to close down. The mom and pops had to close down. Darden has stated that they're going to be building over 1,000 new restaurants. They're able to borrow money cheap because the government's brought down interest rates to such a low level. And they're basically saying, we will buy all of this debt. So when we're looking at the government policies, whether it be in Europe, the United States, the UK, it's built for big corporations to get bigger and small corporations to potentially dissipate and disappear. So I do tend to think that certain industries in the economy are going to affect the stock market, but there are going to be other pieces that are going to benefit from it, from the loss of competitors. So as long as you have a long-term approach, I think sadly, we're going to be benefiting from this on the stock market at the detriment of the general economy.
Mm-hmm. Apologies, it looks like some of the members of the audience couldn't actually see the questions. Hopefully that's fixed. We've got a few more questions that we'll kick into. We've got one from Harpreet. Where do you start when putting a plan together in terms of investing? So what are the aspects that you look at?
Well, naturally, you start with where you are now and where you want to be later on. I love the analogy of the NHS. They do this couch to 5K. So they build, so staying on that fitness theme, they build from, okay, how far can you go? If it's just walking a 5K, go walk a 5K, and then building it into running a little bit and then walking a little bit until you get all the way to running a 5K. I tend to think building a financial plan is the same place. I don't think there's any any limit of how small you can start. So we've had plenty of people call us saying, I don't have a minimum of 500,000 to get into my investments. I can only afford X. Well, just because the financial planning book says that you're supposed to save 15 to 20% of your take-home income to achieve all your financial goals, if you can only afford £100 or $100, start with that, knowing that you need to build it up to that 15 or 20% to get to your long-term goals. So start with where you are, build on small increments, then gauge where you want to be and figure out how to get to those places in between to get to those long-term goals.
No, definitely, going back to the whole thesis of having a plan and, having it in bite-sized chunks where you can actually accomplish them. So going back to the idea of SMART goals. We've got another question from Arti, I believe. Sorry if I butchered your name. So they're trying to save for a specific goal, which is buying a house in the next 6 months. Should this money be invested in the markets to let it grow, or should they be looking to keep it in a more liquid format?
6 months is too short term to be investing right now. When we go into the fixed income markets, most of the time to get anything attractive from the vantage point of the yield, you're going to be doing something exotic, which takes on some form of risk. Depending on what country you're in, if you're say in the United States, there's wonderful programs like Max My Interest, where you can gauge what all the different banks are giving for an interest rate, so that you can maximize your savings rate interest. Same thing here in the UK. There's different little tweaks of programs, but other than a bank deposit program for 6 months, I wouldn't try to risk too much, because you don't want to sit there and give up your potential home property in lieu of just getting greedy.
Yeah, no, definitely. I think real estate has been one of those questions that have popped up, a lot lately, especially with the pandemic and the effects it's likely having to have on the markets in general. So we've got one from Zane. How has COVID affected your relationship with your clients? Is it easy to communicate whilst away, and what are their feelings towards investing? So I guess this goes more back to the whole not being there face to face and having to shift to this digital format.
It's been odd. To be honest, I normally spend the majority of my year on the road and going out to clients' houses. So to spend so much time in their living rooms, but them being in my living room while I'm in their living room, seems odd, but it's a great adjustment. We have essentially 4 cornerstones of our business: communication, teamwork, creative thinking, and adapting to change. And the last 6 months, we've been concentrating fully on that adapting to change. It's meant that we've gotten really involved in doing a lot of these types of webinars. We've been writing twice as much, 3 times as much as we would normally do, but over communicating to the clients. Because while we don't want to tell them that we have information that everybody else doesn't have, i.e. we need to be honest with them that there's so many variables that are unknown, mainly where is this virus going? We need to communicate to them why certain things are happening, why we're not selling out of the whole stock market. That was the hard gauge right off the bat, when we were basically saying the governments are pumping in so much money that they have more money than we'll ever have. Therefore, we need to follow that trend. And now the opposite is happening. We're having to communicate with them why we're not panicking and trying to sell out because we're on all-time highs. Basically, over communication is the key, and everybody has appreciated that from our clientele. Getting on the phone each day and just making sure that we're in contact with them is always the name of the game. But when times are bad, it's even more important than when times are good.
No, definitely. We've got a few more that we'll answer before we end the webinar here. So we've got one from Mr. Gupta. He's got 2 questions rolled into one. The first one is, what are your favorite ETFs and stocks that you're looking at? And the second one is how to invest in precious metals and commodities apart from investing in the companies mining them themselves.
Both good questions. From the stocks vantage point, those stocks that we displayed up in the presentation are some of our favorites right now. Those are the individual stocks. We've also included several individual stocks in China, although we're buying them whenever there's a Trump dump, i.e. whenever Trump goes out there and says something bashing China, saying that he's going to delist all these Chinese companies, et cetera, we get a nice big sell-off in the Alibabas, Baidu, all the bats, and that's giving us an opportunity to buy them at a little bit of a discount. We love these from the vantage point that the renminbi is increasing. We're seeing a lot of growth, and we're seeing more entrepreneurship amongst venture capital in China than we are in the United States. This is a product of how they build their venture capital system, and the fact that the bats are looking to fund people to get them on their payment systems instead of just trying to gobble up whole marketplaces. So it looks more fitting towards entrepreneurs out there in China. So we've been playing a lot in that area and anything X dollar. But essentially, when we're looking at our core side of our portfolio, we've been making big shifts from essentially simple passive indexes into ESG indexes. So removing all those oil stocks. We've actually been playing in some utilities. FAN was one of our favorites of just a simple utility that invests in renewable energy, i.e. boring investment at a cheap price that gets us off just the regular stock market. But we're trying to make sure that we don't overthink things in the overall portfolio to get ourselves off track for our long-term goals.
Mm-hmm. Then I guess to go back to the other question of investing in precious metals, I guess you've got the physical side of things, and then you've got, the silver and the gold miners themselves. So, if you're looking for some diversification away from those miners, then, that would probably be your best bet by going down the physical avenue, or investing in, a number of those ETFs like GLD, like SLD, that have physical on hand.
Most definitely.
Yeah.
Should we switch on to the next question?
Yeah, I think we've probably got one more here. So we've got a question from Ash. So he's got a long-term plan to grow his wealth with a diverse selection of funds. But the question he has is, when do you cash in on good performance? So when do you sell your winners? And should I just be smoothing my payments into the outstanding performers forever, or do I sell and redistribute those profits to the underperforming ones? And how active should he be in those long-term investing goals? So I guess going back to whether you should let your winners ride, or whether you should take some profits and divest them back into your sort of laggards.
There's several questions in there, so we'll try to dissect a few out of it. First of all, to me, we can let winners ride for a long period of time. We have 8 simple criteria that we're looking at for every stock that we're selecting. And when we actually break those down, there's all kinds of subsets. But the most important is that the precursor. Could we close our eyes and own this stock for the next 10 years and it still be around and it still be thriving? If it's not, then we need to start looking at an exit strategy. I.e., we don't want to sit there and play the flavor of the week. We want those good, solid companies represented by good, strong management that we can purchase at a good price. Now, when it comes to averaging down those different pieces, I find that the best way to actually look at that is in a more simplistic vantage point, i.e. looking at that financial plan. If a position becomes too large to where it could interrupt your financial plan, then it is too large for your portfolio, i.e. you need to shrink it down, sell a piece to buy some other pieces and be more diversified. But we have several clients that are sitting on $250,000, $500,000 positions in FANG stocks because they bought them 20 years ago and they've let them ride. We haven't sold out to them because it'd be a huge capital gain. And when we look at the rest of the portfolio minus that FANG position, if that FANG position disappeared, it wouldn't affect them financially in their retirement or in their pre-retirement. So you want to look at how it affects that big picture and those big goals, going back to all of our analogies with the fitness programs.
Mm-hmm. Last question, I guess, before we end the webinar here. Again, from Ash, do you anticipate there being inflation across the world as a result of the various QE programs by governments to help with the economic stimulus to those affected by COVID? And due to that resulting inflation, do you think there'll be a spike in gold prices?
That's the million-dollar question. We've been asking that question for decades, saying that things would stimulate over the course of time. Now, I like to use past precedents just because it's easier to cheat off somebody else's homework than to try to figure things out yourself. And that's to where I would look at all the stimulus that Japan has been putting in their markets for the last 3 decades, and it hasn't impacted any real inflation. Now, we can say that we're 10 years behind in Europe, the UK, and in the United States, even despite all the issues, because of simple demographics. They're about 10 years older. I think they're about 48 years old for the average Japanese person. The average European, Brit, or American is around 37, 38. So we're literally a decade behind them. And therefore, I wouldn't go to assume that we need to have inflation. When we had commodity movements for the last 10 years, the big commodity movements were built on purchases from China, overbuilding from China, and then building that Silk Road and those connections. Now, it really seems like commodity prices could stay low because we won't have a lot of excess purchasing, et cetera, et cetera. And we've got to remember that we still have this technological effect that things are becoming more efficient. So it becomes that typical, East Coast versus centrist economist argument of, is inflation dead versus is there going to be inflation? And just like with our example on the eggs, what I would say is hedge for inflation and celebrate if we don't get it. I'm not investing for inflation. I'm hedging just in case we have it. I'm buying China not because I'm predicting that America is going to the wayside. I'm buying into China as a hedge to not be overly dependent on US FANGs. So protecting your portfolio is that key to how you build your portfolio, so that it's a financial plan, not just a game of roulette at the casino.
No, definitely, I would agree to that latter part of the roulette table. I think that's pretty much all the questions here. So once again, I'd like to thank everyone for attending our webinar. We will be ending the stream here, so thank you all for attending, and have a wonderful evening.
Thanks, Cam. Thanks, everybody. We'll see you soon.